So just to remind us all where we are, we're talking about the major classifications of the balance sheet. We've talked about, we're working on the elements. We've got assets, liabilities, stockholders' equity accounts are all the elements. We're working our way through the assets, and this specifically is on the current assets. So we've done cash and cash equivalents, and now the next item would be our temporary investments, otherwise called short-term investments. So these would be investments in stocks and bonds. So our company has invested in the stock of another company, or they have bought the bonds that were issued by another company. So we're going to be receiving interest revenue on the bonds, we'll be receiving dividend revenue on the stock investments. So our basic thing is how do we classify these in the short-term investments section? And in order to do that, I have to get into a little bit more detail than we probably all want, just to explain what ends up where. This is kind of a summary, so don't let that, discourage you right now. Okay, so we're talking about investments in the stocks and bonds of other companies, stock investments, debt investments, and to be classified as short-term, they have to be investments that management has the intention and the ability to sell within 1 year or the operating cycle, whichever is longer. That's what these three dots are. Sell within 1 year or the operating cycle, whichever is longer. Okay. I'm going to talk about stock investments first, because at this point, they're the easier ones. So stock investments are how we account for them is determined by how much stock we own in the company. Because if you buy the common stock of a company, you get a vote with that. So vote means control. And so if you own enough of the stock of a company, you have a certain amount of influence over them. If you own more than 50% of the stock in a company, then you can control what that company does. So most of your short-term stock investments, we classify them as by how much control you have. So less than 20%. If we own less than 20% of the stock of the company we've invested in, we really don't have any influence over them. We can't tell them what to do. It would be like if I had 10 shares of IBM and I called them up and I said, I think you should try this. They wouldn't even talk to me. Okay, I got no influence. So short-term investments will include stock investments of less than 20% that management intends to sell within a year of the operating cycle, whichever is less. The other place that your stock investments of less than 20% will land would be in your investments section. And this is jumping ahead a little bit, but I kind of have to do this because of the way things end up here. Your stock investments of less than 20% that management intends to sell after the current period would end up in the investment section. So they can end up in a couple of spots. Right now, this is all we're worried about. Okay. So, and just to sort of continue on that vein a little bit with the stocks, if a company owns between 20 and 50% of the stock, then we have some influence, significant influence over that company. Maybe we've bought 40% of the stock of a supplier, and perhaps we'll get our supplies before someone else because we own a significant amount of the stock of that company, and so we have some influence over that company. Those stock investments will be accounted for using the equity method, and those also will land in the investment section of the balance sheet. Okay? If we can control the company, we're going to be filing consolidated financial statements, so we don't get into that right now. But your stock investments, when we're talking about short-term investments, it's going to be stock investments where we own less than 20% of the stock in that company, and management has the intention and the ability to sell them within 1 year or the operating cycle, whichever is longer. Okay, now that brings us to debt investments. Now debt investments, a little easier, they have no vote, so there's no control issues to worry about. However, there are 3 categories where debt investments can end up, and I'm just going to go through those 3 just so you have the perspective on where they end up. Okay, so debt investments can be classified as trading, available for sale, or held to maturity. Okay, so if the debt investment is classified as trading, that means that the management has the intention and the ability to sell that investment within about 90 days, within about 3 months. Okay, so these are trading securities. Debt investments can also end up in the short-term investment section if they are classified as available for sale. Available for sale are basically investments that management intends to sell sometime. And available for sale, depending on when management intends to sell them, can be classified as current or short-term investments if they're going to be sold within a year or the operating cycle, yada yada. Or the debt investments available for sale, if they're planning to sell them after a year, would be in the investment section of the balance sheet. Okay, held to maturity debt investments, these are ones we just plan, you know, when we issue bonds as the issuing company, you'd issue a 10-year or 20-year bond. This is the other side of that, where our company has invested in those debt investments, and we're planning to hold them till they come due. We just want that stream of interest payments coming in over the years. It's part of our cash flow plan. Okay, but what we have to worry about for short-term, debt investments trading, if we're going to sell within 90 days, debt investments available for sale, sell within a year, stock investments, less than 20% ownership, that we're planning to sell within a year. So that's what we're focusing on right now. Okay, so just a little bit more on those. Let's see. We have to figure out at what amount we report them. These are all going to be reported at their fair value on the balance sheet. So if you buy them for $10,000 and then at the end of the year they've changed in value, that whatever their new market value is will be what it's reported at. So they're going to be reported at their current fair value. Any changes in that are going to be reported either on the income statement. For most things it'll be on the income statement, except for one thing that gets reported where the change gets reported on the balance sheet. So your debt investments trading, any changes in that will be reported as an unrealized gain or loss on the income statement, and so that's how those are handled. Your debt investments available for sale, whether they're short or long term, those get reported. The changes in those amounts get reported as unrealized gains or losses, equity, in the stockholders section of the balance sheet. Stockholders' equity section of the balance sheet. Okay, what did I leave out? Your stock investments, all of these go through the income statement, whether they're current or long-term. The stock investments that are less than 20%, it'll be unrealized gain or loss income. Okay, if you're looking at an older textbook, it may be different than that because FASB has changed it within the past couple of years, and now your stock investments, whether they're temporary, short-term, long-term, they go through the income statement. That takes us through the short-term investments, and our next video will move on to the next section of our classified balance sheet.